There is a conversation that John Bogle had privately with a group of Harvard students in 2003 that was never recorded, never transcribed, and that we only know about because one of those students recalled it decades later in his memoirs. Bogle told them something that at the time sounded almost offensive in its simplicity. He told them that most of the sophisticated investors he knew, the ones with MBAs, the ones who read every quarterly report, the ones who followed every market movement with the devotion of a monk studying sacred scripture, were doing exactly the opposite of what they should. They were being too clever for their own good. They were building strategies so elaborate, so full of layers of protection and alternative assets and hedges against apocalyptic scenarios, that they had lost sight of the only truth the market has been confirming without exception for more than a century: that whoever tries to escape the market almost always ends up poorer than whoever stayed. That was 2003. Today, in 2026, that conversation feels more relevant than ever, because there are millions of people right now staring at their portfolios with a mixture of fear and confusion, listening to internet gurus telling them that the financial system is on the edge of collapse, that banks are traps, that gold is the only real asset, that Bitcoin is the ultimate salvation against devaluation, and that any intelligent person should be moving their money away from the stock market and toward anything that does not carry the stamp of Wall Street on it. And there is something true in that concern. Banks do fail. We have seen it. In 2026, we have already witnessed the first bank failure of the year. The discussions about the deposit guarantee system are real. The questions about the soundness of the financial system are not the paranoia of conspiracy theorists. They are legitimate questions that deserve honest answers. But the answer that John Bogle would have given, the answer that his entire body of work built over 50 years of investment career, is not to flee toward gold or toward cryptocurrencies or toward any alternative asset that promises protection without return. Bogle's answer is more radical, more uncomfortable, and more supported by evidence than anything else you will hear in this video, and it is exactly what we are going to explore today, from its historical foundations to its practical application in the financial world of 2026. Stay until the end, because there is an idea at the conclusion of this analysis that Bogle repeated in every interview in the final years of his life, and that most people hear, nod at, and then ignore completely. Today we are going to understand why ignoring it is the most expensive mistake you can make. To understand why Bogle would have rejected with such firmness the narrative of gold and cryptocurrencies as financial salvation, you first need to understand who Bogle was and why his perspective was not that of a man who had never seen danger up close. John Clifton. Bogle was born in 1929. It is not a coincidence that that date is relevant to this story. He was born the same year that 9,000 American banks closed their doors overnight. He was born in the year that families who had done everything right, who had followed every conventional financial piece of advice of their era, who had worked for decades to build savings, walked up to their banks and found the doors padlocked and their accounts empty. His family was not wealthy. The Great Depression hit them directly. Bogle grew up understanding in his own flesh what it means to watch the financial architecture you trusted collapse without warning. That context is fundamental to understanding his philosophy because the simple narrative about Bogle is that he was a man who believed blindly in markets. That narrative is wrong. Bogle was not a naive optimist. He was a deeply risk-aware empiricist who had arrived through decades of research at a counterintuitive conclusion: that the best protection against financial uncertainty was not to flee the market, but to participate in it in the most efficient and lowest-cost way possible. The difference between those two positions, fleeing versus participating efficiently, is everything. And it is the difference that separates investors who build real wealth from those who spend decades running from one safe haven asset to another, paying transaction costs, losing compounded returns, and ending up, at the close of their financial lives, with less than they would have had if they had simply done nothing more than buy the entire market and wait. Before getting into Bogle's specific arguments against gold and cryptocurrencies as primary investment strategies, we need to be honest about the context in which we live, because that context makes the message of this video harder to hear, not easier. In 2026, there are legitimate reasons to feel uneasy about the financial system. The first American Bank of the Year has already failed. Regulatory authorities have been debating restructuring the deposit guarantee system. Congress is considering raising guarantee coverage from $250,000 to $10 million per depositor, and if you are wondering why they would want to do that, the implicit answer is that someone in Washington is worried about whether current coverage is sufficient. Those are not minor signals. They are real data points that deserve real attention. And in that climate, the narrative of gold and cryptocurrencies as salvation has powerful emotional appeal. Gold has 5,000 years of history as a store of value. It is tangible, it is real, you can hold it in your hand. It cannot fail overnight the way a bank can. And Bitcoin has the added advantage of being mathematically constructed to be scarce, of not being controlled by any government, of operating outside the conventional financial system that generates so much distrust. Those arguments are not absurd, they are coherent, and if all that mattered were protecting yourself from the collapse of the banking system, they would be reasonable arguments. The problem, and here is the core of everything Bogle taught, is that protecting yourself from the collapse of the banking system is not the same thing as building long-term wealth. And confusing those two things is the mistake that has cost more investors more money than any other error in modern financial history. John Bogle had a particular way of making complicated arguments seem obvious in retrospect, and his argument against safe haven assets as a primary investment strategy can be reduced to a single question that he asked in his lectures with an almost supernatural patience. What does it produce? That question seems simple. It is not. When you buy a share of a company, you are buying a stake in something that produces. The company manufactures products, provides services, generates revenue, pays salaries, reinvests in its own growth. Over time, if the company is well managed and the market as a whole continues expanding, the value of your stake grows because the underlying thing you invested in is creating real value in the world. The return on your investment has a concrete and verifiable origin. Now apply that same question to gold. What does gold produce? It pays no dividends. It generates no income. It does not reinvest in its own growth. If you buy an ounce of gold today and store it for 20 years, at the end of those 20 years you have exactly 1 ounce of gold. Its value in current currency may have risen, may have fallen, may be exactly where it was when you bought it after adjusting for inflation. Gold produces nothing. It is simply a metal whose price rises when people are afraid and falls when people recover their confidence. It is a thermometer of fear, not a generator of wealth. And Bitcoin, with all its sophisticated technological scaffolding, faces the same question with the same answer. What does Bitcoin produce? It generates no dividends. It produces no goods. It provides no services. Its value exists to the extent that the next person who wants to buy it is willing to pay more than you paid. That is not investment in the sense Bogle used the word. It is pure speculation, which can turn out well or can turn out badly, but which in no case has the backing of an underlying productive value that you can measure and rely upon across decades. Bogle did not say this with contempt. He said it with the cold clarity of someone who had studied the data for half a century. And the data is brutal in its consistency. Across any 20-year period in modern history, the diversified American stock market has outperformed gold. Not in every 5-year period, not in every 10-year period, but in every 20-year period or longer, without a single recorded exception, the market has won. Here is the part of Bogle's story that most unsettles people who have an MBA and have spent years studying finance. The part that makes actively managed fund managers go on the defensive in public interviews. The part that, when you hear it for the first time, seems too simple to be true. The greatest threat to your long-term wealth is not a banking crisis. It is not inflation. It is not a bear market. It is the cost of trying to avoid those things. Think about it this way. Every time you sell your shares because you are afraid of a correction and buy gold, you pay transaction costs. Every time you sell the gold because it seems the market is stabilized and you buy shares again, you pay more transaction costs. Every time you buy Bitcoin because it looks like it is breaking resistance levels and then sell it when it drops 40%, you pay transaction costs and realize losses. Each of those moves on its own seems reasonable. Together, accumulated across a lifetime of investing, they represent a fortune that disappears into commissions, spreads, capital gains taxes, and the opportunity cost of not being in the market during the best days of the year. Bogle calculated this with an almost obsessive precision. He found that the average investor in actively managed funds, the one who pays a professional manager to try to beat the market, consistently ends up earning significantly less than the benchmark index that manager is trying to beat. Not because the managers are incompetent, but because the cost of activity, the management fees, the transaction costs, the taxes generated by constant portfolio turnover, erode returns to the point where beating the market after costs is nearly impossible to do consistently. And, if that is true for professional managers with teams of analysts, legal access to privileged information, decades of experience, and massive computational resources, what are the odds that the individual investor will beat the market by jumping between gold, cryptocurrencies, and stocks every time fear or greed tells them it is time to move? Bogle's answer was direct and unsparing. No statistically significant probability whatsoever. And 50 years of data support that answer with a consistency that should give any honest person who examines it serious pause. When people flee toward gold or cryptocurrencies in response to financial fear, there is something that panic does very effectively. It makes you ignore the power of time. And time is the only asset you cannot buy, cannot recover, and cannot substitute with any alternative asset, however sophisticated it may be. Bogle was famous for using an example so simple that people sometimes dismissed it for exactly that reason. He would imagine two people who started investing at 25. The first person invested $10,000 in an index fund that replicated the entire market and touched nothing for 40 years. The second person was more sophisticated. They studied the markets. They read the analyses. They moved toward gold when the market fell. They moved toward cryptocurrencies when it seemed they offered better returns. They moved back to stocks when the outlook improved. They made, on average, 4 or 5 repositioning decisions per year. At the end of 40 years, the first person systematically had more money than the second. Not marginally more, significantly more. Because every time the second person left the market to protect themselves, they lost not only the bad days they wanted to avoid, but also the good days that inevitably followed. And in financial markets, the best days and the worst days tend to cluster together. If you are not in the market during the worst days, it is almost certain you are also not there during the best ones. There is a statistic that Bogle cited regularly that still hits hard when you hear it for the first time. If an investor in the American market had been out of the market for only the 10 best days of each decade between 1980 and 2020, their total return would have been less than half that of someone who simply stayed invested throughout the entire period. 10 days per decade, not 10 years, 10 days. That is the magnitude of the cost of trying to protect yourself by moving in and out of the market. And gold and cryptocurrencies, with all their emotional appeal as safe haven assets, keep you out of the market at exactly the moments when being in it matters most. There is something psychologically very satisfying about buying gold when the market falls. You feel like you are doing something. You feel like you are taking control of your financial situation. You feel like you are smarter than the investors who stayed put, watching their portfolios fall. That feeling of active control is one of the most powerful experiences an investor can have, and it is also one of the most dangerously deceptive. Bogle devoted a significant portion of his work to exploring investor psychology and reached a conclusion that research in behavioral finance has repeatedly confirmed since then. Human beings are profoundly bad at distinguishing between taking control of our situation and simply doing things that make us feel like we are in control. The difference between those two things is enormous. One produces results. The other produces the sensation of results, while silently destroying accumulated capital. Buying gold when the market falls makes you feel like you are protecting your wealth. But if the data shows that over the long term the market will almost certainly outperform gold, then what you are really doing is trading real return for the feeling of security. And that is one of the most expensive transactions you can make without realizing you are making it. Cryptocurrencies add an additional layer of the illusion of control, because cryptocurrencies do not only offer the feeling of protecting yourself from the conventional financial system, but also the possibility of extraordinary returns. And that combination, protection plus the possibility of getting rich quickly, is nearly irresistible to the human brain. It is exactly the combination that activates all the cognitive biases that behavioral finance researchers have identified as most destructive to long-term wealth. Bogle did not say that cryptocurrencies are necessarily a fraud. He said something more precise and more devastating, that they are a speculative asset whose price depends entirely on what the next person is willing to pay, and that confusing them with investment in the fundamental sense of the word is a categorical error that can have very serious financial consequences for whoever commits it with a significant portion of their net worth. Now we arrive at the practical part, because Bogle was not only a critic, he was a builder, and what he built, the philosophy of investing in low-cost index funds with a long horizon, is not an academic abstraction. It is a concrete methodology that any person with access to an investment account can implement. The central principle is so simple that it seems impossible it could be so effective. Instead of trying to pick winning stocks, instead of trying to predict when the market will rise and when it will fall, instead of looking for the next asset that will outperform all others, you buy the entire market through a low-cost index fund and hold it for decades regardless of what happens. What this means in practical terms in 2026 is that there exists an investment architecture that Bogle would have recognized and approved that requires no special skill in stock selection, no ability to predict market movements, and no willingness to pay significant fees to active managers. It requires only three things: consistency, patience, and the ability to do nothing when fear is screaming at you to do something. Consistency means investing regularly, regardless of whether the market is at all-time highs or in the middle of a correction. This strategy, known as dollar-cost averaging, eliminates the problem of trying to find the perfect moment to enter the market, because you are not trying to find it. You invest the same amount at the same time, interval mechanically and automatically, buying more shares when prices are low and fewer when they are high, without any emotion interfering in the process. Patience means understanding that the relevant horizon for evaluating this strategy is not 1 year, not 5 years, and not even 10 years in some cases. It is the complete horizon of your life as an investor. And across that horizon, the historical evidence is so consistent that Bogle did not present it as a prediction, but as an observation. The diversified market over the long term generates wealth in a way that no alternative asset has been able to replicate consistently. And the ability to do nothing is the hardest of the three, because when the market falls 30% in 3 months, as happens during major corrections, the survival instinct that has helped us thrive as a species for millions of years screams at us to do something to stop the bleeding, to sell, to protect ourselves, to move money toward gold, toward cryptocurrencies, toward anything that seems safer in that moment. And Bogle spent 50 years explaining, with data, with historical evidence, with nearly infinite patience, that exactly in that moment, when instinct screams loudest, is when listening to it is most costly. In the final years of his life, Bogle had a habit of ending his lectures with a question that he left hanging in the air without answering directly. After presenting all the evidence, after demonstrating the costs of excessive activity, after showing the data on the superior long-term performance of the market over any alternative asset, he would ask, "What do you believe in?" It was not a rhetorical question. It was a genuinely philosophical question about the nature of trust in the economic system. Because ultimately, investing in the stock market is not just a financial decision. It is a declaration of confidence that the human economy, with all its imperfections, its cycles of expansion and contraction, its crises and its recoveries, tends over the long term toward the creation of value. It is a bet, supported by more than a century of evidence, that the companies comprising the market will keep finding ways to produce goods and services that people want to buy, that innovation will continue generating growth, that human progress is real and measurable and persistent. Gold and cryptocurrencies, by contrast, are a declaration of distrust. They are a bet that the system will fail, that currencies will lose their value, that governments and institutions will collapse. They may be the right bet in the short term during specific periods of crisis. They have not been the right bet over the long term, where the data shows with overwhelming consistency that the human system of value creation, despite all its problems, has produced more wealth than any asset that bets against it. Bogle did not ignore the real risks of the financial system. He had lived them since childhood. He had studied them for decades. He understood them better than most. But he had reached the conclusion, through evidence and not blind faith, that the answer to those risks was not to escape the system, but to participate in it in the most efficient way possible, minimizing costs, maximizing diversification, and letting time do the work that no alternative asset can do consistently. That was his answer to fear. Not gold, not Bitcoin. Time, discipline, and faith, backed by data, that the long-term human market tends upward. Let us return to the starting point, to the legitimate fear that many people feel in 2026 when they look at the financial system and see signals of instability. That fear is real. The questions it generates are valid, and they deserve honest answers, not answers designed to sell gold or cryptocurrencies to someone who is frightened. The honest answer is that there are intelligent ways to manage financial risk that do not involve abandoning the market. There are real protection tools, from proper diversification to direct U.S. Treasury instruments, that do not require betting against the entire economic system. There are financial architectures that allow you to be prudent without being self-destructive with your own accumulated wealth. But the honest answer also includes this. If your primary long-term investment strategy is built on gold or cryptocurrencies as wealth-generating assets, the historical data is telling you something uncomfortable that deserves to be heard. Not because the conventional financial system is perfect, not because banks are infallible, not because the market will never fall again, but because, across the time horizons that matter for genuine wealth building, the evidence compiled over more than a century points in one direction with a consistency that no alternative asset has managed to challenge. John Bogle spent his entire career building one argument: that the market is not your enemy, that volatility is not the same thing as risk, that the real risk, the one that quietly destroys more wealth than any market crash ever has, is the cost of trying to escape the market every time it becomes uncomfortable. He built that argument not on faith, but on 50 years of data. And the data, in 2026, is still saying the same thing it has always said. The question is not whether the financial system has risks. It does. The question is whether the way you are responding to those risks is making you wealthier or poorer over time. And that question, honestly examined with actual numbers across actual decades of market history, has an answer that most people who are rushing toward gold and crypto right now do not want to hear. Stop running. Stay invested. Let time work. That is the entire Bogle philosophy reduced to its irreducible core. And in 50 years, not one piece of evidence has emerged to seriously challenge it. If this analysis made you see your own financial decisions from a different angle, if it raised questions you had not considered before, or if it challenged assumptions you had been taking for granted, then this channel is exactly where you need to be. We do not give you headlines. We give you frameworks for thinking clearly about the decisions that will determine your financial future. Subscribe right now and turn on notifications so you do not miss a single analysis. And leave your thoughts in the comments below. Do you think Bogle was right? Are you holding gold or crypto as a significant part of your portfolio? And why? Your perspective genuinely shapes the conversations we have here. We read every comment. See you in the next video. Disclaimer. This content is a speculative geopolitical analysis and a simulation of future scenarios, 2025 to 2026. It does not constitute breaking news or verified facts of the present. The aim of the video is educational and documentary, exploring theories of defense and the global economy. This channel supports YouTube's policies against disinformation, clarifying that everything presented is an analytical interpretation by the author.